Good afternoon, everyone. It's Coram and Ed Carson here with a look at the market for Tuesday, April 25th, where we saw some damage in the major indexes today. But will big tech earnings be the saving grace or put the nail in this rally's coffin, Ed?
Yeah, it certainly was not a good day, and there was more weakness than the indexes showed, so it was really not very positive in that regard. I want to take a look at three stocks: Rambus, ServiceNow, and BJ's Wholesale.
All right, we will look at those. But first, let's take a look at the major indexes. Today, the NASDAQ down 2% by sessions close, and it was pretty much a slow bleed throughout the day and no relief by sessions end. The S&P 500 up 1.6% today. We have the Dow down 1%, and with the weakness in regional banks, the Russell taking an especially hard hit. The small cap index down over 2% today. So the NASDAQ, which had been trading sideways, along with many of the other major indexes, broke below some key levels today. We saw further deterioration below the 21-day line. We're below the 12,000 level, and now testing this 50-day line, Ed.
Yeah, and so you've said it all there. I mean, it's like that's what's going on. After all this sideways action, we didn't know which way it would break, and we don't know which way. I mean, because maybe we break higher on earnings and then fall back and fall back. So we could be in a period of volatility, but this is not good. Now we're at the point where we really need to see some positive action from this point on. Not good here. We had banking fears, you say, like, this First Republic had, sort of melting down, reviving those concerns, KRE coming down to the lowest level since late 2020. There were some China concerns. We saw a lot of commodities come off. And so that's hitting. There's even talk about another COVID wave there, more recession concerns. So just a lot of things going on that just the glass half full is starting to look a little emptier. And just people are getting nervous, and we'll see. It could still turn around, but this was definitely a damaging day.
Because also we have now closed below the low of the follow-through day, at least on the NASDAQ, Ed.
Yeah, you're right. That is not a positive sign. That's a sign that, usually when you close below the low of a follow-through day, that is a pretty negative sign for the health of the rally. It doesn't mean that the rally is finished, but it does mean that there are real concerns going forward.
Yes. And let's take a look at the S&P 500 and see how it fared. It's still holding above its follow-through day area, but slicing below the 21-day line today. As you said, we were trying to see which way we would break. We're breaking lower. We'll have to see the potential impact of these big tech earnings. But this is the thing. We can't just hang our hat on, these big tech earnings, they're going to save us. Surely the market will power back up. When you have to react to what you see, not what you hope to see in the future.
Yeah, I mean, the market was looking okay, and some things were working. There was not a whole lot of stocks were working great. There was a reason to be modestly exposed, but not treated like it was some wild bull market. And now we're seeing something new, and the new is not good so far.
And let's look at the Dow coming down to its 21-day line as well, backing off of 34,000. IWM, a big day down today and breaking below a lower trend line here. So headed back towards its lows. And then let's take a look at RSP. This is the equal weighted S&P 500, now back at its 200-day after hitting resistance around the 50-day line, coming off 1.7%. So slightly outsized loss here than the market cap weighted S&P and QQEW as well. We'll go there, down 2.1%, slicing below its 50-day line. QQQ, meanwhile, still holding up better, but below its 21-day and approaching the 50-day line. SMH chips, Ed, this is not a great development here.
Yeah, this was weakening here and there, and it's like, okay, it's pulling back. This is healthy. No, it's not healthy anymore. I mean, let's just put it. I mean, it doesn't mean you can't get healthy again, but this was not good. Some stocks, and we'll look at some stocks that have been holding up, started really faltering. Others that had been faltering are really starting to break down, including some that have been big winners. So this is a bad sign for the market. Because chips were leading. That's always a great sign. Chips are now sort of leading the downside. Definitely a negative.
And this is why it can be tricky to be buying off of the 50-day line, and why a lot of times we like seeing um, stocks or ETFs prove their strength a little bit more after a pullback. But like you said, not great to see this here today. And then software. This is another area that we've been looking at as potential signs of life in the growth area in 2023, but taking a huge hit today. This IGV ETF down over 3%.
Yeah, and this actually doesn't look as bad, but maybe not really reflective because Microsoft and Salesforce, which did not have good days, but they've been holding up a lot better. There's a lot of cloud software names that have really come under pressure in the last week or two and really suffered today.
And now let's take a look at those three stocks we want to highlight. Here's Rambus in the chip sector, down 7%, round tripping a breakout and then some, closing below the 50-day line. So if we're starting to see these leading chip stocks even break down, is this a temporary rotation? Is this a sign that the weakness that we saw sort of percolating underneath the surface is really starting to accelerate? What should we be thinking here?
I mean, look, if the tech earnings come a lot better and sounds like IT spending is great and there's a new resolution to the latest flare up on banks, you could imagine, oh, everything looks better again. And so this will be just a horrible day. But this is really, yeah, when you saw this, like this was one of those that was really holding up well. Up until yesterday, it was still holding, going steady. And to have that sudden sell off on really no specific news,
Hmm.
I think it's a really negative sign. And given that this is so many others look so much worse,
Right.
yeah, just really, I think is a pretty negative signal here.
hmm And ServiceNow, which was a former leader and starting to turn around, was looking like it was forming a constructive cup with handle here. That handle is now a lot bigger after today's 6.5% plunge in heavy volume. We do have earnings tomorrow, but it doesn't seem like this is one we'd want to be holding into the earnings report. It's looking a little vulnerable here.
Yeah, boy, that one really sold off into the close too. And not that it was having a bad day the whole day, but yeah, the handle is still there. I assume it's still valid. Yeah, it's still
Hmm.
valid. But
Hmm.
uh, yeah, all of a sudden that's just not. What was looking one of the strongest names in software is now buckling. And so that's what you see often when the market weakens is that you'll see certain stocks hold up until they don't. And while there are areas outside of tech that are
Right.
doing well, the tech sector really looks damaged.
hmm And last but not least, let's take a look at ticker BJ. This is in the retail area, holding up better than a lot of stocks today. Its decline was just about 1%, light volume, and this flat base that it's been forming has been coming in mostly light volume as well. So looking decent here, but it's not like it's the most booming growth stock there ever was, Ed.
No, it's not. It's not. It had faster growth in the latest quarter, but it's not supposed to have amazing growth in the next 2 years. It's holding up fine. A few days ago, probably had an early entry from a
Mhm.
downward slope or just about on the sideways. But at this point, I think you could probably just wait for a breakout, and it wouldn't be too far from the 50-day line. But it's
Mhm.
like, it's just one to be watching.
Right.
But you wouldn't want to if you had a portfolio of this in tech stocks, you're still going to be losing because it's like not just because it's down today, but because it's going sideways or not really making progress and other things are coming down. So we're seeing a lot more defensive names, defensive growth names come up. Real growth names are struggling, and just investors have to be aware of that and react to that.
Mhm. Here's the trick though, Ed. We do have earnings out from the likes of Microsoft and Google. Microsoft up solidly in the early going. The initial reaction on the earnings beat has shares up over 4%, and Google parent Alphabet also up about 4% in reaction to its results. As of now, it doesn't mean that we're going to see these stocks up 4% when the bell rings tomorrow morning at 9:30.
Yeah, it's important, and Microsoft in particular likes to give its conference, give its earnings guidance late into the call, and so often it'll change dramatically. What looks like a great report doesn't look so great an hour later. So watch for that. And we're also seeing Meta and Amazon, which report later in the week. They're also getting a sympathy move. You're seeing the Qs rise today. So we'll see. But yeah, we could have, even if we have a good open, we have Meta, we have ServiceNow, we have a bunch of others coming in. So you can't just say, oh, we're getting a bounce back, everything's going to be fine. Well, yeah, I mean, I think we need to see more strength. We're at the situation where you need to see a fair amount of strength just to get back to where we were a few days ago. And I think so. Investors should be definitely cautious until you start seeing some real strength, not just momentary after hours bounce.
A tricky market right now, that is for sure. Well, thank you, Ed, so much for providing clarity when there's so much gray area in the market. And thanks everyone for watching. We'll be back with more tomorrow morning on IBD Live. You don't want to miss it. Investors.com/IBD Live for all the details. And we'll see you right back here after the close. See you there.